Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at the market site in Times Square, we have Bob Smith. He's a co-founder and president and CIO of Sage Advisory. We're going to take a look at ESG and sustainability trends, certainly a hot topic in 2020 and beyond. Bob, it's great to have you back with me. At market site, ESG just continues to grow in popularity.
Yes, Jill, it does, and it's very nice to see you again. ESG is just exploding. I think we're at a watershed period in several different areas. One is more and more corporations are willing to report the data that's so very important for investors to make evaluations in regard to their environmental impact, their social impact, and their governance practices and so forth. Every single day on the news headlines, we see evidence of an ESG related factor that creates concern, and how managements are dealing with them is something that investors increasingly want to know.
All right, let's go along to our first chart here, responsible investment, and the data supports it. It's gathering momentum.
Oh my goodness, this is a wonderful chart. This comes from the UN Principles for Responsible Investing, and this is a chart of worldwide growth in assets. We're at $85 trillion as of the end of 2018. It's even higher now. That represents globally all the assets that are dedicated towards sustainable investing. The US component of that is at about $12 trillion as we stand today. That's up 38% from where it was just 2 years ago. The orange line are the number of organizations, investment managers and public fund owners that have signed on to the principles for responsible investing. And it's showing you a very clear trend that more and more investors are becoming more inclined to want to know how to manage these risks and whether the companies they're investing in are doing a good job of it.
All right, moving along to our next chart here. The obvious question is, it's not just a trend, so why do you want to invest?
Well, first thing is we know that a lot of ESG issues, while they're non-financial, have some very significant material impact to financial statements and outcomes. It's not just environmental and resource management, it's supply chain management. It is also issues in terms of what are you doing in terms of your consumer products and improving the brand in terms of, as we well know, everybody likes to have sustainable products at home for their families and so forth, so brand management becomes very important. So materiality is being now questioned more and more. We're seeing more information, more providers of that information making it available to the public. Organizations like MSCI just yesterday releasing to the public now all their evaluations of ESG factors related to well over 3,000 companies that they follow, and making that available to the public so the public is well informed. So knowing what's material is the first issue, and I think we're getting to a clearer and clearer idea as to what is material in ESG. The second is market demand. Growth is just on the ascendancy, as we saw in the previous chart, but let's recognize that there was a survey done by Insights Research, and what they did is they surveyed the top 400 advisors in the FT annual 400 Top Advisor Survey. 69% of those advisors said that they now use ESG or ESG products and information in their practices. That's up from 40% not 2 years ago. And when you sit there and look at the growth in terms of the number of funds that have been brought to the market, more funds that are ESG oriented and ETFs that are ESG oriented, we're now at well over 350. That was a couple of hundred, not 3-4 years ago.
Right, and are you seeing it translate into stock prices at this point or returns?
What we're starting to see is that it does start to reveal itself in periods of downturns. For instance, last year, when we had that swoon in the market in the fourth quarter, guess what you saw? The ESG equity-oriented funds did better than the average actively managed equity fund, and of the top 10 funds during that horrible period, at least 2, if not 4 of them were ESG optimized. So in periods of weakness for the market, when there's adversity, generally these funds show up quite well. But what we're seeing now more and more is that over the long term, ESG-oriented kind of risk management is now adding more and more to the bottom line of investors. So what's the issue? The issue, I think, is that availability. We're up to about 350 funds or so that are available in terms of funds and ETFs, and yet that's not enough. Why do I say that? You look at the millennials out there. Millennials today represent somewhere in the area of 75% of the American workforce by 2025, according to Deloitte. They represent 35 million households. So if you put in Gen X as well, that's another 35 million households. What do you think they want to invest in? Merrill Lynch tells us, according to their surveys, that 3/4 of those millennials would say they want to invest more sustainably, more responsibly, but they don't have choices. And it shows up. The 401k data that we looked at says that only 4% of all funds that are employed in the 401k market right now are ESG oriented. Less than 1/3 of 1% of assets are invested in that way. But the future, the blue ocean for this, is that more investment management firms will be coming to market because the demands from the workforce of America, the millennials of America, is going to grow like topsy.
All right, well, that's encouraging. You can only go up from here. All right, Bob, thanks so much for joining us as always. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.